Welcome to Daily Trader. I'm Tom White here, filling in for Kevin Hinks. We're going to go through a couple of trades today. We're going to lead off with big tech and earnings. Alphabet, Google's parent, reports after the close today. The option market pricing in about a plus or minus $8.80 move either way based on what's going on in the overall market. Now, the stock's pulled back about 16% so far this year, off about 23% from those all-time highs that we saw in early February. So it's pulled back pretty significantly in bear market territory. Implied volatility, while elevated compared to historical levels, typically going into an earnings event, we see a lot more implied volatility. But with the market rally the last three sessions, we've seen the IV percentile rank come in just a little bit, but still some elevated volatility in here. They've got some headwinds, whether it's search, ChatGPT as a new competitor in the search business. Remember, about 70% of their revenue is generated through advertising through their search business on Google. The other 30% is dissected between cloud and some other areas within the company. Now, they still have the regulatory issues. They're in court right now. Maybe the spinoff of the Chrome browser going to take place. So keep that in mind going into earnings. So I looked at a strategy in here using the option market, leveraging that higher implied volatility. We're looking at a back ratio here. It's a 1-by-2 ratio spread where I'm actually going to collect a credit on it. And what this type of strategy does, it allows you to take advantage of a move higher in the stock. It allows you to take advantage of if the stock just consolidates, and you can actually also profit if the stock falls. You just don't want it to fall through a specific level. So let's walk through the details of this trade, this back ratio. This is out in the May 2nd weekly cycle, so not a pure earnings play. We got 8 days to expiration on this trade where we're going to buy one of the May 2nd weekly, the 155 strike puts, sell two of the 152.5 strike puts. So there's that 1-by-2 ratio, buying one of the 155 puts, selling two of the 152.5 strike puts. Now, you're going to collect a credit of about $2.30 on this trade, and that is what you can profit on. You can see here from the risk profile, if the stock remains above that 155 level, hey, you just get to keep that $230 per spread on this this trade. Now, if the stock pulls back a little bit, and goes at or near that strike where you sold two options on the 152.5 strike, you get a little bit of a kicker where your max profitability can be about $480. Now, where's the break even where you start losing money? We always like to talk about what's my downside on this? Well, your downside is below that break even of about $147.70 to the downside. That's about a $10 move below the current share price in Google Alphabet. So you've got a nice big cushion to the downside. And what's your risk on this trade? Well, it's $14,770, but that's if the stock goes to zero. So, most likely won't happen, but it's always a possibility. So we've got to mention that. But break even $147.70 to the downside. Now, why does the risk profile look like this? Well, you're basically buying a $2.50 wide put vertical, buying one of the 155 puts, selling one of the 152.5 puts, but then you're selling an extra put on that 152.5 strike. So you've got a naked short put there, or a cash secured put. So you've got a lot of risk to the downside. This trade's twofold. You either think the stock's going to go higher, maybe go a little bit lower, stay where it is. But if it goes lower, hey, if you want to keep those two short puts open, I'm willing to buy the shares at $147.70 because that's your break even where you'd have to purchase those shares. So you got that big $10 cushion to the downside on this particular trade. So this might be one way to look at Google Alphabet going into earnings. If 3 out of 4 scenarios, you profit in this one. Goes higher, stays where it is, goes lower, but remains above that break even of $147.70. You got 8 days in that position, so you got a little bit of duration also. Now let's move on to another big tech name. They report earnings on the 30th of April, and that's Meta Platforms. Earlier this week, Meta Platforms was on a 7-session losing streak. It's regained some strength over the last couple of sessions due to the overall market rebounding here a little bit. But the stock's still down about 29% from those all-time highs that we saw earlier this year, off about 10% in 2025 also. So some big selling here. Now, what do you look at Meta Platforms besides that earnings event on the 30th of April next week? Well, The fact that it's got $3.3 billion or 3.3 billion daily active users across their platform, whether it's Instagram, Facebook, WhatsApp, and others. So keep that into consideration. This is going to be a big test on digital advertising dollars because Meta Platforms makes over 95% of their money through digital ad spend. That's going to be really key going into these earnings. We'll get some clarity with Alphabet's results tonight after the close. But I looked at a different strategy in here where I'm going to take advantage of vol dispersion for a bullish example. If you think Meta's going to maybe rally, maybe make up some ground that it's lost over the last couple of months, down 29% in bear market territory, this strategy takes advantage of that while using volatility dispersion. So we're going to go out to the May 9th weekly options. That's 15 days to expiration. And we're going to basically buy something slightly in the money, the 525 strike call, basically at the money, maybe slightly in the money. Buy the 525 call. And then against it, in the May 2nd weekly options, we're going to sell the 560 call. Now, that option series captures that earnings event, right? So it's got the higher implied volatility levels. So you're buying a lower vol, selling a higher vol due to that vol dispersion that we're talking about. Now, this is basically a $35 wide bullish call diagonal, right? The difference between the two strikes. The debit you're going to pay on this is going to be about $17 debit. That means your risk is going to be per spread $1,700 per spread. Now, you can see here from the risk profile, anything above maybe 531, 532, maybe 530 is going to be profitability on this. So you need a move to the upside in this, but it's not like a big outsized percentage move. You just need it to kind of get, grind higher. Now, where's the apex of profitability? Well, next week's or May 9th weekly options or May 2nd weekly options, you've got about a $50 range plus or minus that the option market's pricing in at this point. So they expect some movement going into those earnings, but you're taking advantage of that vol dispersion, as I mentioned. $17 debit for a $35 wide call diagonal. That's pretty good. That vol dispersion lowers the entry point and risk on a position like this. Now, you've got some assignment risk on that short 560 call over the next 8 days into May 2nd weekly expiration, but you'll also have that ability to roll or adjust that short strike over the next week, basically, to increase credits, increase potential profitability. Apex of profitability, as I mentioned, you want it to go up at or near 560, but because you're paying less than half the width of this call diagonal, anything above maybe that 530, 531 level is going to be profitability on this type of trade. And this is a bullish call diagonal example there in Meta if you think this stock's going to continue to rise. And you know what? You got almost a week until earnings on this one. So if it continues to move higher with the overall market ahead of time, it might start expanding where you could actually close it before earnings if the market's open. So keep that in mind also on that bullish call example there that we have in Meta Platforms. All right, that's going to wrap up Daily Trader today. Make sure you tune into the Schwab Network 24/7, schwabnetwork.com. Thanks.